Hey, what's up, guys? This is Ruben here once again from Tenacious Tribe. Hope you guys have had a fantastic trading day last Friday, yesterday. Yesterday I cannot publish. I started off my article, my post. I ended up not doing because I was traveling back to Portugal to meet up my family, where I am right now. Coimbra, in case you're wondering, very beautiful country, very beautiful city. Heading off to the beach this afternoon. I'll do some surfing, be with my dogs, be with my friends, my family, and that's it. Having this that I posted this morning already. If you guys haven't seen it already, drop by my blog and you'll see another post about the training asset of the day, as of yesterday, of course. Subject being Rivian Automotive, the stock I'm going to talk to you guys about today. If it's the first time you're watching one of these videos, you know already that our methodology, what I propose here to do is to look for any asset, any trendy asset from a price action technical analysis perspective. Reinstating, I do not care about fundamentals. I do not care about maybe a market cap only for technical purposes, so to say. I mean, price to book value, price earnings, the debt to equity ratio, dividend yield percentage, earnings growth, which is important also for technical perspective. But I mean, I don't typically look at it. I don't care about those sort of informations. I don't care about the macro economical perspective from all those the economists out there. I don't care if I'm shorting Apple, if the price is telling me to do so. I mean, I wouldn't say I would do that. I've built for myself three main strategies, and none of them encompasses a short strategy. I don't think it yields. It has to be beyond perfectly executed to yield effortless good results over the longer run. And so I prefer to be long on the stock market and yeah. What am I looking for in that case? If it's not the fundamentals, I'm looking for candlestick patterns, chart patterns, technical indicator signals, bullish divergence, bearish divergence, volume signs, trends, stage analysis, EMA's crossovers, all sorts of hints that can allow me to form to establish an idea of where the bulls are in the market, what's the sentiment, where the bears are in the market, where should I expect them for future references, which case is the strongest case, bullish or bearish at the moment to ring to, and also which bullish and bearish plan can we sort of devise based upon this information in order to build a reasonable or a rational trading strategy. And off we go. Stock of the day once again, Rivian Automotive. This stock was picking up a lot of interest. This has very few price action on my favorite time frame, the monthly time frame. Another hint on what I do here. I prefer the longer time frames for reason already mentioned, which I have no problems in mentioning again. It's very good at regulating my emotions and allowing me not to jump into every idea that I have. So it sort of gives me a buffer. It gives me a buffer, as in today I got the idea of trading Rivian. Perhaps it's a good idea, but I mean, if I'm trading on a month time frame, then I'm gonna have to wait 20 more days until 18 more days until I actually receive a trigger from this market and can conclude that the last candle was a trigger, and this should also oblige me to rationalize the reasons behind what I'm doing it, running the numbers, understanding if I have an edge on the long run, and understanding if I should do this instead of trading my own back tested run strategies. I'm not saying it's not work. It does work, but I prefer to trade the things that I've exactly and over and over back tested, and I mastered, that I know what's going to happen, what could happen, how much can I risk, how much should I risk. Uh, those are those are the strategies I'm more inclined into pursuing. That's one of the reasons why I like the multi time frame. Very good at regulating emotions. One, very good at not at preventing me from jumping into all my trading ideas. Having this said, off we go. Yet again, not much price action on this multi time frame. we can already see like the market structure wise, we had a downtrend as of the outset, as of the moment when this share was first floating back in November 2021. Let's see what the weekly time frame says. It perhaps has more price clues than the monthly. Of course, that if you can establish a downtrend as of November 2021 on the time frame, at the same frame for the weekly. One touch, two touches, three touches, not a touch here, but four touches. We have a valid downtrend here. Another way for you guys to establish the market structure is you see here, for instance, that you have lower highs and lower lows. This one was very strong actually, but you keep on seeing all the trend line, all the price action respects this trend line. This downward sloping trend line. This is a downtrend. This downtrend happened as of the outset, almost from November 2021 until May, where we are right now. Then why do we care about this market structure? Why do we care about where the market is or is trading? Because we know that the market is trading, that as traders, the best odds of our survival, of our profitability, is trading with a trend. Let's say, for instance, the market is in a downtrend. You see a breakdown and a retest. You know that of the moment that the previous market structure is broken, namely this lower time frame ranging area, we know that we're better off trading with a trend. In this case, for instance, we could have gone short here in case you guys command a short trade. Same follows for this place here. You got here the bearish flag breakdown, the bearish flag. This can will be a good trigger for you guys to go short. So yeah, market in a downtrend. As an individual trader, you're better off trading with a trend, respecting the trend direction. The trend direction here says go short. What happens when there's a market structure change, as the one we got here? I mean, classical technical analysis says that after a downtrend, you typically have an accumulation phase or a ranging market before the market sets back into an uptrend. So what can we expect from this market? Perhaps, we never know. We always need to get more signs and more signs from the market and look for these good risk reward setups. But something we could expect from this market is for this market to range, to enter in an accumulation stage where it's not going to be making neither new higher highs, neither nor new higher lows, just making something like this until it breaks out or it breaks below this range. And then if it breaks out, starting an uptrend, breaking the structure. If it breaks down, then starting and resuming the downtrend, market shifts. We know that the odds are we traded the trend. In a ranging market, our best odds as traders is to buy at support and sell at resistance, provided we got the correct triggers and the correct context. Okay, so now we know that the odds are we're gonna have a ranging market here. We know that the odds are we're gonna have better odds of being profitable if we buy from support and sell from resistance. What support and resistance? Next things to establish. Volume profile analysis is very good at this game at establishing what are the relevant levels. But I mean, the price action analysis can also give you a lot of hints of where the bears and bulls might be. You can definitely see here that the bear step from here. This is not a relevant level right now. Anyway, it's too far away from the price. I'd say the relevant levels right now are. This one is a level. You can even include all these candles there. This is overhead supply. You see that bears here, bears here, bears here. Yeah, I got a couple of flies here in my attic in Portugal. In case you guys were wondering why I'm doing this random signs. That's pretty much the explanation. I live in the countryside. My family lives in the countryside here back in Portugal. So yeah, we got a lot of life around here, which I kind of fancy. Back in Madrid, it's a little bit different. A lot of noise, a lot of things going on. Too many sometimes. I kind of like this balance. Uh, Getting back to our analysis, we know that bear step from here. See that there was selling pressure here, and then there was a downtrend. Bear stepping from here, break down below, downward first as off the trend line. Downtrend resumes. downtrend resumes. There's a small congestion zone here with a bearish flag here. Break below, price trends below. Bears are here. Okay, so we can expect that this could be our resistance level. As to our support demand area, I guess that that is a prominent answer here. I mean, this candle. Let's see what the volume has to say about it. Point number one. The volume says right, yeah, the volume says there's a volume divergence, price volume divergence here. Richard Wyckoff, it's very important for the foundations of my work here. I think that he gives a fantastic thesis on how to analyze. First of all, why. I'm not going to disclose it today. Keep on watching my episodes. I'm going to be here for a while, I hope. Um, but yeah, Richard Wyckoff is very good at providing the theoretical basis on how to analyze price volume action. According to his work, this is a divergence between price and volume. When you see a candle like this, you want to see this sort of volume. When you see a bigger candle on the price, you want to see a bigger candle on the volume. When you see a smaller candle on the price, you want to see a smaller candle on the volume. In this case, you got a very small candle, very small. I would even call it a bearish candle because the price like closed below the previous candles close. I'd even call this a bearish candle, but it's a very small candle in size in comparison to its volume. I mean, the comparison that Anna Cowling, which is a disciple from Richard Wyckoff, says about this candle is that it can sort of compare it with a car that's moving upwards a hill. That's yeah. I'm sorry for my English. Sometimes it's not perfect. I hope it's enough for you guys to understand these concepts. So the car goes uphill, and the hill is so steep at the very end of the hill that when you're pressing the gas, you keep hearing the engine making noise, but the car is no longer going upwards because there's too much weight overhead, so to say. Yeah, this basically means that it's time for the car to step down. Boom. And this or in price action trading language, this means that a lot of bears or panicking investors selling here and thinking that this price is not going to hold. They've seen that there's a very steep downtrend here, so they're more in time to sell. And there's very big money here, very very happy and saying thank you, sell to me. I'm willing to buy. Sell me all you can. I'm gonna buy everything. And this is gonna be support and demand area. Then you receive this candle here, further confirming this is a support and demand. So support or demand area. I use support and demand sort of as similar terms. This is not 100% correct, but I mean what I'm looking for is zones where the bulls and the bears are, and both these concepts can be used like interchangeably to understand where both these parties could be. So yeah, this is demand for sure. As to the signs of strength and signs of weakness from this market, what we got here, we got on the bearish side, a very steep downtrend, a textbook shooting star candle here. A lot of obstacles on the way up for the bulls. These are three signals that the bears are very present in this market, and you cannot ignore these price areas. On the bullish side, what we have here, first of all, this volume with this candle is very very prominent. This is bullish territory. Anything can happen, of course, and price overrules volume. This candle is very small, but I mean, this is a very solid footprint of bullish presence. The same thing as follows for this candle here, and you see already that the price the break of the trend line is also bullish. Of course, it means that this trajectory, this price movement, this downtrend has come to an end. I think I've seen something else in this market that was relevant. Yeah, the bullish divergence on RSI. This is one of the most powerful signs out there for price action analysis. This is a very good pattern for you to call the end or a trend reversal or the end of a trend, basically. And look at how, as of this moment here, the price is going downwards, is making new lower lows. See, lower low. Whereas and divergently in the RSI, the price is the plot is making new wire highs and it's in an uptrend. This means that the momentum is no longer bearish as of this moment here. You can expect a reversal to happen, which it did afterwards. And this is a very good example of a bullish RSI bullish divergence and of what happened afterwards, a trend reversal. Not saying it's going to go to an uptrend or established that this might go into an accumulation phase, just saying that the RSI worked, the RSI divergence signal worked, and we're no longer in downtrend for now. What else? For further reference, I mean, I like to call here some old school classic technical analysis textbook examples for for further reference for your curiosity, for you to see that technical analysis actually works, and it's all over the place, every time frame, every asset class, every asset, it's there. This is a classical bearish flag. Look at what happened at the breakout downtrend. This is a classical shooting star candle, very strong one with a very big upper wick. Look at what happened afterwards. Boom, a very small sell, a very big sell off. This is also classic break down below this threshold and the retest here. Look, breakdown, very strong candle, retest this previous support turning into resistance now. Price moves downwards afterwards. Very strong signal also. The trend line here, also very good example of technical analysis and how it works. And keep those in mind for future references. Now, synthesizing this information and trying to convert it into a bullish and bearish plan. We know already that obvious place for us to place our stop loss is below this demand level. We know that if the guys that are supporting this the price at this level are no longer in this market, or conversely, if you have the price breaking below this level, then we know that the guys that are supporting this market are no longer there or are very keen to sell because they're seeing red in their P&L. So logical place to put your stop loss. You know that bears are here. Logical place to put your take profit. Let's see if this makes sense on a risk to reward perspective. It doesn't, because risk to reward ratio is below 1. Okay, this doesn't make sense on a bullish on the bullish case. Let's see if we get a good bullish shine here. Yeah, if you have like a breakout here, also not. I mean, I won't. I mean, unless you are a long-term investor and you cannot buying until it reaches this level, I won't step in this trade because it does not make sense from a risk reward perspective. From this time frame and from this philosophy, it wouldn't make sense. Of course, there are a zillion ways for you to trade, different time frames, 1 minute, 5 minutes, 2 minutes, 1 year, everything. There are a lot of possibilities here. From this possibility here, from this perspective that I'm offering you guys, I wouldn't say it makes sense for you to go long here because the risk reward ratio doesn't make sense here, unless you're for a swing trade perspective, of course. Unless you guys want to go for long term and hope that the price beats this obstacle, and gets back here and perhaps beats this obstacle. Maybe you're a long term investor. Then it can make sense. Always no financial advice. Always manage risk. Always manage risk. That's the most important message I got for you guys, of course. On the bearish side, similar to the thought, different scenario. Market is accumulating. Market could be ranging. We know that during ranging markets, it tends to work like this. You know that the price tests already support. If it gets back to resistance and we get a bearish trigger, then let's see if it could make sense. It could. I mean, risk reward ratio 1.58. This is quite poor. I prefer a risk reward ratio of 2 at least. I mean, it's already acceptable. If you guys are more entrepreneurial, if you guys love risks, then maybe this is something for you. Not for me, definitely not at all. I don't like to short on stocks. Best case scenario, I got 100% win. Worst case scenario, I can lose money indefinitely. Conversely, on the bullish side, my profits are illimited and my risk is limited. And also, stocks tend to go up on the long term. So, no brainer for me. That's all I got for you guys today. 20 seconds. Self-imposed time cap of 20 minutes. Hope you guys have enjoyed it. If you did, just press the like button or not. Hope this was useful for you guys. Comment, interact. I love to talk about this. Cheers, guys. Happy trading.